Hey champs, welcome back to Libertas Trading and welcome to the event preview for UK quarterly GDP on Thursday, the 13th of November 2025 at 7 o'clock UK time. So just a quick heads up, same as the Aussie jobs data, I am traveling back to UK from Switzerland tomorrow. So it's a little bit of a travel day for me, which means I won't be at my desk. So this is being recorded Tuesday night. I'm just getting on top of the job with this one. So anything that comes out in markets Wednesday, which includes the Aussie jobs print on Thursday morning, won't be included in this preview. So yeah, sorry about that. In terms of the UK economy at the moment, we won't go into too much detail because we did speak about that at a bit more at greater length in yesterday's labour market preview that I released. But we had a really weak jobs print today, which is obviously bad for the pound. We've got sticky inflation, we've got stagnant growth, we've got high wages. We've basically got a stagflationary economy. We've also got Rachel Reeves' autumn budget coming up on November the 26th, which is expected to be negative for the pound, just as her March spring budget was as well. So there's quite a lot going on for the pound at the moment. We've also got 18 basis points of cuts priced in for the December meeting. We've got 29 basis points priced in for the Feb meeting, and we've got 60 basis points priced for the rest of next year. So for that reason, and for last month's reaction, we can expect a little bit more of a medium-term play here and hopefully a longer move. I am a bit worried about today's labour market print, which came in absolutely perfect for pound shorts and price didn't do too much. So we'll quickly look at that. So here we've got, pretty dismal stuff for the UK economy. We've got the ONS figures, which, can't be trusted, but still they all came in lower. We've got earnings that came in lower. Private payrolls growth came in at multi-year lows. The payrolls change coming at minus 32k with a massive revision on last month's print as well. So, really bad stuff here for the UK and for the pound, but, the pound basically completely reversed. So this was against the dollar. We'll quickly check the euro chart out. I'm not going to be biased on this one. The euro did trade a bit nicer, but still, considering that massive print we got and the repricing in rates markets, we would expect a bigger move than this. So, this print yesterday has put me off having a full size position tomorrow and also holding longer term positions. But having said that, last month's or last quarter's GDP reacted quite nicely. So we'll quickly look at that one in a second. So this was Q2 data in August. So just to let you know that this is, a lagging data print. We're getting June data come in August, but it's the best we got. So we'll go with it. If it moves markets, we'll get involved. You can see here we had some massive beats basically across the board. Most of the prints coming in above the max. We had quarterly GDP come in 0.2% higher. We had that year on year coming in 0.2% higher and above the max. The important services figures came in really high, 0.3% above the consensus on that yearly print. And then, again, just really nice numbers. So we did have a bit of a retracement, but a really nice move lower throughout the morning session. Again, we had that standard 7:30 candle, which continued downside price action, which is something worth looking at. Really nice movement here from last quarter's figures. And this is promising for a bit more of a medium-term trade tomorrow. So just heading over to the trade scenario plan. So just a quick heads up before we get into this sort of stuff. After Tuesday's disappointing reaction to the UK labour data, I'll be looking for slightly larger deviations than usual to initiate a trade. It's just such a disappointing reaction that I'm not going to be going off anything unless it's massive. Also, I'll be mindful of worse entries than expected, so I'll be double checking my position size and risk before pulling the trigger, which is always really important. So now just looking at the numbers. So for a dovish reaction, I'll be looking at minus 0.3% or lower on the GDP month on month, and then 0.3% or higher on the GDP month on month. And then for the year on year, I'll be looking at 1% or lower, which would be below the low and would be the joint lowest since June 2024. Which would be pretty dismal stuff. Probably not surprising, but dismal all the same. And then for a hawkish reaction, I'd be looking at 1.6% or higher, which would be above the max. And with June would be the highest print since March, which would be encouraging stuff. So for the services number, I'll be looking at minus 0.2% or lower, which would be a contraction in the only growing part of the UK economy and the lowest since June. So again, makes up 80% of the economy. So these service numbers are really important. And then for a hawkish reaction, I'd be looking at 0.4% or higher, which would be above the max and the highest since Feb, which would be really nice. So for the year on year for the services, I'll be looking at 1.5% or lower, which is below the minimum and the prior. I'll quickly change that now. Apologies for the typo. And then for a hawkish reaction, I'd be looking at 2% or higher, which would be above the max on a 2 handle and would show solid growth from the only part of the UK economy which really matters right now. Another typo, 1 second. How unprofessional of me. Embarrassing. For the quarterly data, I'll be looking at minus 0.1% or lower, which is below the minimum and the first negative print since Q4 of 2023, which should spook the markets a little bit. It should definitely spook Rachel Reeves. And then for a hawkish reaction, I'll be looking at 0.4% or higher, which is above the max and 0.3% higher than the Bank of England's own projections that we got last Thursday. So, that could be some pretty hawkish stuff. And then for the year-on-year quarterly figure, I'll be looking at 1.2% or lower, which would be below the minimum and the lowest since May. And then for a hawkish reaction, 1.6% or higher, which is above the max and in line with June. It would be the highest since March. So again, we're expecting pound lower of a dovish reaction and pound higher on a hawkish reaction. Again, these numbers, we are looking for them on aggregate. So we don't need every single one of these to come in at this number and every single one of these coming at this number, but we want most of these coming in below the minimum in an ideal scenario. And as I said, I am looking for slightly larger deviations just due to yesterday's number, which was today's reaction, which was pretty disappointing. So in terms of medium-term plays, so for a hawkish reaction, it's pretty hard to buy the pound at the moment, and it pains me to say that I would buy the pound, but I would look for some euro pound downside if we got some really hawkish numbers here. It's the purest rates play for the pound. There's not much going on with the euro at the moment, so that could be quite nice. And we've also really struggled at breaking above that 88.10, 88.30 level. So just quickly looking at the euro pound chart. So this is the daily chart where we broke above that 87.50 level, which is a little bit discouraging, but just going down to the hourly chart, we can see that this sort of 88.10, 88.30 level is being respected quite well. And the fact that it was respected after such weak jobs numbers is quite encouraging as well. So I'd be looking for some downside in the pair, maybe targeting 87.60, maybe getting down to this 87.40 level. Of course, it depends what happens tomorrow in markets. Just to repeat, I am recording this on Tuesday, so take all of this with a slightly larger pinch of salt than usual. And then for a dovish reaction, you could look at some pound Kiwi shorts. So the Kiwi's been pretty strong today and looks pretty oversold across the markets in general. So we've got market internals that are put into New Zealand dollar upside across the board. Technically, we're at a really good level and there's some nice seasonal weakness for the pair. So anyone looking for a bit of a mean reversion trade on the Kiwi, you could look at some pound Kiwi shorts. So just checking the charts out on that one. So yeah, momentum has been pretty solid on the pair. Of course, the pound's been pretty bid this year and the Kiwi's been pretty weak. But we have found some nice resistance from this 23.40 level or 2.34 level. So some downside from there could be quite nice. Maybe targeting 2300 or 2.28. And then also we can look for some pound Swiss franc downside if we get a bit of risk off going into the Thursday morning session. So the Swiss franc has been on a rampage today and looks the only safe currency to park money in right now, with the yen and the dollar selling off whilst the franc strengthens. The trend is your friend on this one, and it really wouldn't be a surprise to see it break below recent lows. So we are at recent lows in the pair, but with euro franc and dollar franc, still looking like they've got some more room to run and they're not at their respective lows yet. I wouldn't worry too much about that one. So just quickly looking at the pound franc chart. So yeah, as I said, we are nearing these lows down here, but with dollar franc with a bit more room to run and also euro franc with a bit more room to run, I wouldn't expect the pound franc to be that important. I'm sure we could break through these lows nice and easy on a really weak number. So in terms of short-term plays, so for any scalps, I'll only be looking to trade the pound dollar and the euro pound, going for what's strongest or weakest before the release and also favouring a sell over a buy. To check sentiment, I'll simply look at the euro US dollar price action. So for the euro pound, I'll be going for a 6 pip target. And then for pound dollar, I'll be going for an 8.5 pip target. As I mentioned up here, I will be double checking my position size before pulling the trigger, because on the UK labour print today, we saw massive spikes in price action, which yeah, it made me risk a little bit more than I felt comfortable with. So learn from that, we move on, and tomorrow I'll be double checking that before I enter any positions. So 4 out of the 5 most recent tradable prints, it would have been better to enter 10 seconds after the release of the data. So it gives you time to digest that massive data deluge we'll be getting. So yeah, basically that's it for the preview. For anyone who hasn't yet, please subscribe to our Substack at Libertas Trading. We did about 7 videos last week. I think I've done 3 previews and a weekend video this week. So yeah, it's all free to subscribe. No credit card details needed. Be good to have you here, and any feedback, give me a message on here. And yeah, good luck.